Right, Caroline, thank you so much for that. Of course, we have been awaiting the president of Chile's central bank to discuss all of those topics that you mentioned, including the higher inflation that we're seeing, also the GDP growth forecast being elevated. But at the same time, we continue to see these challenges for the country, including that Santiago lockdown. The Chile Central Bank President Mario Marcel is joining me now on the phone. President Marcel, thank you so much for joining us right now. Let's talk a little bit about that new lockdown in Santiago. When will this start affecting your latest projections?
Yes, well, first of all, thank you very much for having me. The government announced a new lockdown in the Santiago metropolitan region starting tomorrow. In terms of its impact on economic activity, we believe it would be mild, probably milder than it was in March and April. In April, we had 85% of the population, of the whole country population, under lockdown. And now with this lockdown in Santiago, we will go to 60%, so right. That will be lower. And in March and April, when we had cumulative lockdowns, month on month, we only had a drop in economic activity of 1.5%. So this time it should be lower, perhaps closer to zero.
But coming at a time when you're trying to really pare back stimulus, right? So with all of this uncertainty, given that you're one of the highest vaccinated countries in the world, how are you going to craft monetary policy forward when you don't know what's happening with these infections?
Well, what we know is that the economy is considerably more resilient to lockdowns and the impact of the pandemic, much more resilient than it was last year. We know that we ended last year in a very dynamic recovery of the economy that continued into the first months of this year. And now, starting now in June, we will have the additional impulse of these fiscal measures that will provide subsidies to 15 million people in the country. So that's a very large share of the population sustained over 4 months. So that's a very important impulse on economic on demand.
But that also means that inflation is accelerating faster and actually going to top your target for this year. So how urgently do you feel the need to raise rates?
Well, inflation in the last reading was 3.6% for headline inflation. Well, we are experiencing the kind of pressure that many countries in the world are having, coming from oil prices, especially compared to the low levels of last year, transportation costs, some raw materials. But on top of that, in terms of the longer-term pressures, which is what is important for monetary policy, the output gap is closing faster than expected, and that's why after forecasting to keep the interest rate at its effective zero lower bound until the beginning of next year, now we say that we are bringing that a little forward because of a more dynamic demand.
How much forward? Markets are pricing a rate hike as soon as next month.
Well, I mean, I cannot be extremely precise about that. Of course, it's something that we will assess from one meeting to another.
Will it be in the summer?
But I mean, what I could say is that, well, you know that we use this device called the rates corridor to charter what may be expected from monetary policy, and that moved forward a little more than a quarter compared to the sensibility that reflected a more expansionary policy in the previous reading. So. I mean, it's something that we will assess over the next few meetings, but what looks pretty likely is that it's certainly coming this year.
So what's the point of holding back, though? I mean, it seems like you will have to raise eventually, and you're saying within this year. So what's the point of waiting?
Well, consider that precisely because of the lockdowns, in terms of the dynamic of the output gap, we are currently at the time when the output gap, after closing relatively fast, is opening again. Not certainly not at the scale that we saw last year, but it's broadening a little. So we need to see the dynamics of activity to see that the economy is in a path to a more sustained closing of the output gap to move ahead.
So
As I said, I mean, right now, inflation is not extremely far from our target, so it looks like there is policy space to assess and make good decisions.
So you talk about the economic recovery. Does that also mean that you won't have to buy local treasury bonds then?
Well, we are allowed to buy treasury bonds only in a case where financial stability may be at risk. That was the core of the reform that Congress passed last year. What we are allowed to buy and what we have been buying is bank bonds. But we ended the purchase program a few months ago. We have kept stable the stock of those bonds until now in June, reinvesting coupons. But we announced already, like 2 months ago, that we will do that. We would do that only until June, and then we would allow the stock to go down according to redemptions.
So let me just ask you about the political uncertainty in Chile as well. You have a new constitution this year. You also have a presidential election. What message is all of this uncertainty sending to foreign investors, and how will this impact long-term investments into your country?
Well, of course, there is a concentration of political events. This year, we will have 4 elections in a row, ending with the presidential and parliamentary election at the end of the year. The constitutional body will be working. We will start working in July, and we'll have a whole year to elaborate the proposal for a new constitution. So it seems to me that now that we already know the composition, then that in a couple of weeks, this constitutional body will start to work elaborating its internal rules. We will know how the process will evolve, and that would allow people to understand better how this would go ahead.